All right, he's ready to go. So let's get started. Let's go to automation and let's go to zone trading also. So let's first go over zone trading. We won't make this too long a video, but I want to touch base on both of them. So we have, and this is an indicator based zone strategy where we get these demand and supply zones that can come up on any market. What we're doing is we're looking for major possible reversals when the market pulls back, grabs a lot of liquidity, and then continues its move in the direction of the overall push of the market. So we have two settings that we can put on our indicator. So the indicator we have for you members to put in your own chart, the indicator is called the SYM outer edge indicator, SYM outer edge indicator. So what you're looking at right now, you can put it on a blank chart if you want. I have two indicators put in the same indicator, the SYM outer edge. I put 100 and this is a 200. This is the deep, both are deep supply and demand zone levels. I'm only looking for big moves out of the market. We're looking for the market to reverse inside of these zones. It cannot close outside the zone, or we do not look to trade the zone at all. These are deep liquidity grab, demand and supply zones. So you can enter all four if you want, the 25, 50, 100, 200. I like to look at the larger zones, the larger, what you call the deep demand supply zones, especially the NASDAQ on a wild market like that. It tends to blow through these shorter zones. These larger zones tend to hold and reverse. So you can enter it twice. These are all standard with the indicator it comes with. But you put your speed period to 100, speed candles to 0, ATR ticks to 54, second ATR ticks to 38. The SYM bar type, this is key. You got to put the SYM Rinko bar type. This is our proprietary bar type I created with filters built into it already. It's our Rinko bar type that was created. It's not the Uni Rinko bar. This is our own bar type that we created for the room. See, and I'm going to show you how we do this on the automation too in a second. We're running a replay on it right now. I'll go over the automation in a second. But put 100 and 200 in. Once you put those in, you put them on the chart. You get these levels that come up. You get the shallow demand supply zones with the 25 and 50 setting. That means you're going to get a lot of different setups where the market is 10 in a small range, hitting the high zone, hitting the demand zone, hitting the supply, hitting demand back and forth. The deep zones are where you're looking for a big run in the market. This is where price gets inside of the projected zone. Now, these zones are projected. They're very leading. They're going to show you this zone 15 minutes, half hour, hour and a half before it even hits the zone. You know, we've seen that several times this week already. You have to come at the zone or inside the zone by a close. Once it closes inside of it, it must get a V-top. And once that V-top comes in, you're looking for a push in the market. All right. If you get it up into the zone and it closes outside the zone, we are not looking for a market to reverse. Okay. So these are the two settings to put in, 100 and 200. For the deeper ones, I put those on this chart at this level. And then the shallow ones are 25 and 50. If you want to add those, you're just going to get a lot more setups. Okay. So as we look for trades to come through, you're looking for reversals at these key zones when they come up, and you're looking for it to, you know, for a possible reversal when we get into these zones on the deeper shallow zones. Just remember, you don't want to close outside of it. You want to close right inside of it and then get a reversal. Here's a buy. You want to come down to it. You want to see it reverse right inside of this deep zone. It cannot close outside of it by one candle. And then the market usually proceeds to push in that direction if it can close exactly inside that zone. These are not small pushes that these larger zones, when they finally do qualify, create a nice opportunity for us on catching V bottoms or V tops as far as that goes. Let's get into automation. Let's go to automation. So let's say that you get into a zone here at this level, or you get into a sell zone back here, buy zone or sell zone, and we're reversing inside the market. You can use Chart Trader to fire in the trade, or we can use we have a strategy that will take the first liquidity grab after the V top or V bottom. So we have a 30-year back-tested zone trend that likes to reverse the S&P. It's the most highest probability trade we have in the direction of overall trend, is getting inside one of these zones with overall trend, 30-year back-tested trend. So if you see that occur, what's going to happen is the automated strategy will get you short. If you want to let it get you in, it will get you in at this first distortion of price. You get into the zone. There's two ways you can use our automated strategy. You could click it on under your control center and let it take you short on the first liquidity grab, getting into these large zones and letting it manage your trade for you. Or you can use Chart Trader and enter it after the V top comes in, or the V top comes in, or V bottom, and let Chart Trader automatically trail your position for you that Ninja has. So that's one way you can use our automated strategy. You can let it come into these zones. You know that's the highest probability trade of the session. We're looking for a big push. And then you can use our automated strategy to fire in that trade in the direction of the overall direction of the overall zone push. Now, what you can do if you want full automation, where you want to run, let's say 9:35 to, let's take a look at this. Let's take a look at the strategy first. Let's say you want to run from 9:30 a.m. to 11 a.m. only. So here's how you can do automation. Automation is going to look for the first liquidity grab after the market gets into a trend, either trend up or trend down. You can put the SymmRenko bar type instead of the Unirenko into your strategy. This is the automated strategy. This is if you're going to let it run from a certain period. I have it running from 9:30 to 11 o'clock on this replay. 9:30 to 11. If you want to let it run from 1:30 or 9:30 to 4 o'clock, then you put 9:30 to 1600. I put the ticks, 1,000 ticks to 1,000 ticks, target to 1,000 ticks, because you're going upon the profit target and the profit loss. Now, this is a 1-to-2 ratio. You can go to 1-to-1 ratio and see what it does. In other words, you can do a 300 profit target with a 300 stop loss, 100 profit target, $200 stop loss, so on, and just run your replay and see what it does. This is a 1-to-2 ratio. For those that are doing Apex and some of these other funded trading accounts, a 1-to-2 works really good on these larger Renko sizes, which I'll go over. We'll go over on, now we can use larger Renko sizes for round-the-clock automation, because we're looking for a dollar target amount for my overall stop. This is based upon one contract. So it's going to take out a $500 target, $1,000 stop loss on these larger Renko sizes. You can go 1-to-1 if you want to, 500 to 500. You can go 2-to-1. You can go 1,000 profit target, stop loss 500. You can go 3-to-1, $300, $1,000 target with a $300 stop loss. You can run all these scenarios that you want to see how that you want to do it as far as that goes. But you can put in the strategy allows you the automation. If you want to run full automation, then you can dictate what time you want it to let it run. If you're just looking for the busiest hour, the most volume of the New York session, it'd be the morning session, 9:30 to 11. You can let it run or what have you. If you do that, if you let it run from, let's say, 9:30 to 11, it's not going to wait for the first trend change, meaning it's not going to wait for the first red candle to close. It's going to take the first liquidity grab after 9:35 on the larger Renko sizes, which works really well. The first liquidity grab after the New York opens up at 9:30. So what you're telling yourself, I'm looking for the first liquidity grab to pull me in if I'm 9:30 to 11. If you do not put 9:30 to 11, you put, let's say, 1:30 in the morning to 4 o'clock at night. What it's going to do is going to wait for the first trend change here and then take the first liquidity grab to get you long the market. And I'll show you how that works here in a second also. So when you're doing these trades, this 9:30, 11, it's only going to look for trades from 9:30 to 11 o'clock when we run the market. If you have 9:30 in there, 9:30. See, this one ran at 9:42.14 after this deep liquidity grab. So that's one way you can use it. You can let the strategy run on these longer Renko sizes, because these larger Renko sizes, let me show you what it is. It's a 1-1-500. You can use a 1-1-1000, 1-1-500. They're very large Renko sizes because you can do it now, because what you're doing is you're letting it be a dollar stop value. It's not the tick. So with the older version, you had to use this big stop loss because that is the tick value, right? Well, we don't need to do that because now it's going based upon a dollar stop value and a dollar target value. So what it'll do is if you go from 9:35, let's say you run a 1-1-500 here, or a 1-1-1000, a very large tick size, a tick reversal size. What you're telling yourself is you're getting in the largest distortion of prices. We're trying to find out when they're grabbing the most liquidity, because we're not using a small Renko chart to find fake liquidity grabs. We're trying to find real liquidity grabs during the session where they're actually grabbing liquidity, and they typically do it right after New York. So a great strategy to use with an automation is you start looking at these trades and start looking from 9:30 to 11, because that's the most volume, and it will only trade from that 9:30 to 11. It won't take trades outside that. Or you can look for trades from 9:30 to 1600. Put that in. Put your stop ticks out to 1,000. Target one ticks out to 1,000, because you're going on a dollar value. Now you can do the micros on this too, so it'd be a $100 stop loss and a $50 gain per trade. Micros are 1/10 of the big contract. But what I'm showing you is what I like to do. This is how I passed the $150,000 within a week and a half past the Apex Trading Challenge, using larger Renko sizes with predetermined profit, predetermined stop losses, and not using the tick size of the reversal as your stop. We don't need to do that anymore. Now it's strictly a total dollar amount. So what you can do when you're doing automation is this. My profit target, I can go to 3 to 1. This is a 1 to 2. Reward to risk, 1 to 2. You can go 2 to 1. You can put 1,000 profit target, stop loss 500. You can go to 3 to 1 profit, our reward to risk, put a $1,000 profit target, stop loss of 300 for a 3-to-1 reward to risk. You can change this even on large Renko sizes. So we can use large Renko sizes. And when you do market replay on this, you can see how effective this can be, because what we're doing, we're truly getting in where the market liquidity grabs are happening. You're not getting 1,000 liquidity grabs a day. You know, you're looking for 9:30 to 11. The large liquidity grabs, I mean, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So we get about 15 liquidity grabs since around 11, 15, just almost 20. But look at the big ones. 1, 2, only 3 large liquidity grabs that happened in that session between 9:30 and 11. And if you started out, if you look for your strategy, I like the strategy to look for the first liquidity grab after the New York Open. It typically works really well because it's catching the first deep liquidity grab, because that's typically when they push the market and you get a nice push. So wherever you put the time, that's where it's going to start. Okay. So here's another one at 9:30. I did market replay again today. This morning, this one came in at 9:37, time of day trade. Liquidity grab trade. Now you can have larger profit targets, because remember, those red, you get once you get a trade that comes up, a buy or a sell, you're going to get a stop loss where you can trail this. So as soon as this comes up, this buy comes up, you're going to get a red line that pops up for your stop. Your blue line would have popped up here for your target. So once this pops up, these will automatically adjust for you, the profit line and the stop line. But as you're moving up and you want to keep it below the liquidity grabs like this and so on, you can do that. You can drag, you can click and drag if you want to. On larger Renko sizes, I just let it do its thing. I don't like messing with it. Just like full automation, like it run and do its thing. But you can do that as far as on these larger Renkos now, on taking trades during active hours in the market. Now, if I look at the whole, if I go to these large distortion in prices off larger Renko sizes, so let's say I look at a 1/1000 tick reversal. What it's telling me is I want to see where the smart money is trying to grab major liquidity grabs, because there's not many of them. If you put on small Renko charts, there's just tons of liquidity grabs, and you don't know which ones are going to be the possible big liquidity grabs. So when you go into larger Renko size like this, on a larger Renko, it shows you where the possible big liquidity grabs are, and you can position yourself. The strategy will position yourself in grabbing that liquidity, on positioning yourself short or long into that liquidity grab. So what it'll do is it will always take trades right after a major reversal in trend. It will look for the first distortion in price. And same thing, when you go into the strategy, you can use a SymmRenko. Here's SymmRenko reversal. I put a 25 in there, 54.38, 130 to 1600. Stop ticks 1,000, target ticks 1,000, because I have a 1-to-2 reward ratio. This is what I used in the Apex to pass both Apex accounts, was a 1-to-2. You can use a 2-to-1, 3-to-1, a 1-to-2, 1-to-3. You can market replay and see which fits you best on your Renko size you use. But my point is that just because we're using, I just showed you we had a 1-1-500, and this is a 1-1-1000. Just because we're using a large Renko size, it doesn't mean we have to use this large. We don't have to use this large reversal stop. It's a dollar value whether you use 1 to 6 contracts. Now, if I did 6 contracts, you don't have to get all the way down to this 36, you know, because I'm shorting it at 40 3/4, and it got down to 36 to cover for the $500 gain. You use 6 contracts, you're getting out here, you're getting out earlier. Or you do 3 contracts, you know, you're getting out somewhere in here, or 2 contracts, you're getting somewhere out in here. You don't have to let the run be as pronounced because you're doing more contracts. So increasing your contract size, it's always the dollar amount of the strategy. If the strategy is a $500 target price and you're doing 3 contracts, when that dollar amount gets 500, it's going to exit you out once it ticks to that. That's a cool thing about the strategy. All right. So when you're getting in these reversals, it's going to look for the first distortion in price and get you long. I like using on these larger Renko sizes, just like we do our indicator for our zones. I like using the 25 sim Renko as a trend filter to get into these reversals. Now I ran this replay this morning. I'll show you the results in a second, but so this is what you're doing. You're looking for the first liquidity grab after a trend change, or if you put 9:30, let's say you want to use a 1-1-1000 and trade it just from 9:30 to 4 o'clock at night. It will only take trades from 9:30 to 4 o'clock. And it will look for the first liquidity grab after it starts ticking at 9:30 and hold that runner until your profit target is hit. Now we're not having to trade on micro charts, micro managed charts. We can trade larger Renko sizes because I have a pronounced I have a dollar value where we can get in and out of these trades. Okay, a dollar value. So on the buy setup, same thing. They'll look for the first liquidity grab after the push. It's happened at 1 o'clock in the afternoon. It's going to look for the first liquidity grab, $500 target price, same exact scenario, right? Now, if I put a 9:35 to 11 o'clock, it's not going to trade during that time period, you know, but it's the same scenario. It's going to look for the first liquidity grab. If you trade around the clock, let's say you trade this from 1:30 in the morning to 4 o'clock at night, straight through it, not turning it off. You know, obviously do not leave a strategy by itself. Anything can happen. But my point is, it would take all trades after a trend change, a first liquidity grab. If you put a specific time in, like 9:35 or 9:30 to start to 11, it's going to take the first liquidity grab after that New York opens up. So this I have just running it around the clock, right? It's going to take the first one. So when you get into, when I did market replay real quick on this 1-to-2 ratio. So when we're doing larger Renko sizes, what we're counting on is we're counting on what? We're counting on getting large liquidity grabs only, not trading a lot. If you want to triple this or double it, go down to 1-1-500, and you're going to double your trades, if not triple your trades. My point is that obviously past performance is not indicative of future results. We know that. But you can see what type of results you can get using large liquidity grabs over a month period. This is a monthly period on just using large liquidity grabs only, not trying to micromanage and look for these demand and sell zones on looking for 15 to 16 trades a day or 10 trades a day. Obviously, the 100 sim Renko will only get usually 3 or 4 trades a day off of our indicator. But my point is, you can slow this down if you want to use automation. This is taking it took every single trade from 1:30 to 4 o'clock from March 31st until yesterday. So you can run a strategy on a longer Renko size now, whether it be this, or if you want to go 500, cut this in half and take the first liquidity grab that happens off of a 500 chart. And this is a 1-1-500. My point that I want to show you is You start going down to 120 on strategy automation. Why? There's too many retracements. There's too many liquidity grabs. Now look at it. Look at the whole session of liquidity grabs you're getting. You're not getting a lot of them. So what you're doing is you're putting yourself in a position where you're actually getting in with the push of the grab on larger sizes, and still, especially if you like to do, if you don't like to do prop trading, because prop trading with Apex and so on and Top Step and all that, they give you a certain amount of contracts you can do. You really only need to do one contract on this. You don't need to do, if you want it, you can do up to 6 contracts on our strategy. It just means if you do 6 and you have a $500 stop loss or a $300 stop loss, it's all 6 contracts combined. But the profit target is the same way. It's going to get you out a lot earlier. It's going to get you out like right there on 6 contracts with $500 profit. So you can try that too if you like that, instead of just doing one contract and so on. If you don't want to take the risk and do micros, micros are 1/10 of the big contract. So if I want to do micros and I come in, now remember, past performance not indicative of future results. We know this. This is educational software, but this would be a $500 profit over the last month on those 10 trades. So, or 5 trades. So based upon using a large Renko size, it's 1/10 of the big contract, 1/10 of the loss. So if I come in, I do micros. If I do micros, then I want to put my profit target as 50 and my stop loss as 100. When I do micros, I want to change that ratio, the 1-to-2 or whatever you want to do. If you want to do 2-to-1, 3-to-1, totally up to you how do you want to do it. The key is this with these Renko sizes. You got to use market replay, guys, or you're not going to know how this is going to perform. You cannot just look at historical data. You can't hit historical data and click here and hit historical data, right? You got to come in, hit it real time after you're done market replay, and then see what type of results you're getting after you let it run on market replay. Market replay is really, really simple to do. It's not hard to do. You come in, go to connections, disconnect. Hit playback, download the days, connect it. Here's your days that you have, and you can run replay and see how the strategy does before you even start simming it. Once you get good results on like this, what I educate traders to do is put up a 1-1-500 on the ES and a 1-1-1000. Run the 1-1-1000 around the clock. 130 to 1600 with a 500 profit target, stop loss, a 1-to-2 ratio. For you guys who do prop accounts, you can run that. For those of you running your own account, maybe you can do the micros, 1/10 of the big contract, and run that. I'd run this one, and then I'd run the one just to get a feel for how liquidity grab strategies work. And run a 1-1-500. Do the same thing. Do a 1-to-2. Put 25 SymmRenko as your trend. 54.38 is the same, but I would do market replay from 9/3/11 and just replay it for the entire month, the last 2 months. See what type of performance you get. Do a 1-1000. Run it from 9:30 to 4 o'clock. Look over the last 3 months. Do a market replay. See your results. Then you're going to find out we can accomplish getting liquidity grabs with larger Renko sizes, because now we're doing a dollar base value, not a tick value.